Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with Chris White, author of Working with the Emotional Investor. He's a veteran wealth advisor. And man, what a time to be talking about emotional investing when the stock market is continuously hitting all-time high after all-time high. We have precious metals, which have been in somewhat of a bear market. We're starting to see that turn around. Gold is solidly over $1,300 now, but it's been a rough past few years, certainly, especially in the mining sector. And Bitcoin and cryptocurrencies. And so we have Chris with 25 years as an advisor, and we're going to discuss with him today emotional investing. Chris, thanks for coming on Crush the Street with me.
Ken, it's a pleasure. Thank you so much for having me.
Well, Chris, you are the author of Working with the Emotional Investor, and people can pick that up at chriswhiteauthor.com. That is your website. I highly recommend everyone to go there. Let's talk about emotional investing. Maybe let's just talk about a general start, kind of your philosophy behind emotional investing. I mean, we're all human, right? And so how do we approach this big macro topic of investing?
Well, so to start with, all investing is emotional. Now, you'll talk with a lot of people, who've been in this field for decades, and they have steely eyes, and they don't admit to having any emotions. But if you scratch the surface, you'll see very quickly that, in fact, beneath that steely exterior, even those wizened professionals have a gut, and that gut tightens up when things are not going right. So all investing is emotional. And the second point I'd make is that we all live in two worlds. The first world is one that's low stakes, it's easygoing, casual, no worries. And the second is high stakes. And it's in the high stakes world that most of us exist when we start talking about our money and how to invest it and how to make money and hopefully not to lose it. And so, that's the fear and greed component that drives the Bitcoin mania. It drives the market higher, and at some point, as we saw in 07, 08, 09, it causes the market to stumble and then to crash. And so those are it's in that high stakes environment that this book really comes into play. Because we each have a different response to that high stakes world, and that depends on our personalities. And the book goes into a lot of detail in terms of our understanding ourselves, so that we can better understand how to navigate successfully those high stakes conditions.
Okay, so let's look at cryptocurrency right now. Bitcoin has been one of those things that have been on a tear. And it's taken a breather over the last week, coming off of 20,000 and going down to 10,000. Last I checked, it was just under 15,000. But it's hardly a crash when you consider that it was $1,000 at the beginning of 2017, and 25 cents in 2011, and starting off at a penny and below that. For its first transaction. The psychology of being able to hold on to Bitcoin as it goes up 10x, 100x, and beyond is unfathomable. There's not that many people who were into Bitcoin in 2011 who are sitting on $15,000 Bitcoin today, because it's very difficult to hold on to a 10x return, much less a 100x return. And so I'd like to get your thoughts on the psychology of this type of market, the exponentially growing market?
You know, when you see the parabolic move on the asset price, I don't care what it is, if it's Amazon or a Bitcoin, you have to be you have to be crazy if you're not feeling a little nervous, because usually those parabolic moves have some retracement, and there's a correction in the future. You know, it all depends on where you got in, and this is part of the psychology. This is the anchoring bias, if you will. If we bought at 15 and it's now 10, well, this is the most disastrous investment we could possibly have ever made. But if we bought at 30 cents and it corrects from 20 down to 10, what's the big deal? You know, we still have huge gains in it. So there is that framing aspect of, where it was that we got in, and that will trigger that high stakes environment for us. So if I go back to the personality types, and these are personality types that were really worked out by a psychologist across the river from me in Cambridge. I'm in Boston now, watching the blizzard outside. But the David Cantor is the psychologist over in Cambridge, and he has been working in this field for 40 plus years. He's in his late 80s now. He came up with 3 different personality types: the fixer, the protector, and the survivor. And I took those models of his and applied them to the financial world. So the fixer, who has to win at all costs, and Mr. Trump is a great example of a fixer. The fixer is a risk taker, and they don't mind taking on risk. They seek risk. In fact, they love it because they have to win at all costs. Whereas the protector is very risk averse. They tend to feel anxious very quickly, and they will back away from situations where they feel like there's too much at risk. In the crash in 08-09, I had a lot of protector clients who wanted to sell everything. That is such a classic protector response to the market sell-off. A protector would want to be bailing out a Bitcoin as soon as they saw that parabolic move on the price charts, whereas the fixer would love that and want to go in more. And if there were a correction, they would want to double down because they couldn't stand having just left some money on the table when the Bitcoin value went down. The last one is a survivor. The survivor tends to, Ernest Shackleton, who's an explorer, is a great example of a survivor. They tend to be great savers. They would never participate in a Bitcoin move because they're just sort of plodding along. They're more focused on their causes than they are on trying to win, and gain tremendous wealth. So it's really often the fixers who are in this for blood, and they grapple with this idea of if they've lost, they are ready to. If they've lost any money, they're ready to double down, and hoping to take the next ride up.
So, Chris, do you have a specific sort of strategy to emotional investing? And I guess my thought is, do you, in this Bitcoin example, or maybe in the precious metals world, with gold and silver, things peaked in around 2011. It was this euphoria phase, and things started coming down. And everyone likes to be the one. Everyone assumes and thinks they are the prudent investor and buying when there's blood in the streets. And right. 2013, I could tell you the mining sector was 50% off, and that was a blood in the streets moment. But who would have thought in 2014 it would go another 50% off, and then 2015 another 50% off. And the psychology of that, as you are trying to make the prudent decision, is very taxing on the individual. And so, any thoughts on this sort of investing, and or what is your general bias towards how you invest your money?
Well, so first of all, because we're all emotional, it's very important for us to understand who we are, of those personality types. What is our makeup? Or do we tend to seek risk, or do we tend to be risk averse? Do we like to double down? Do we have to win, or are we ready to feel that anxiety in us and back off a little bit? So number one, it's very important to know who we are. Know thyself. That's the old adage. For me, I'm very grateful for all the training I received at Columbia Business School, because it really provided me with the tools to be quantitative. So I know my emotional side, and I know the mental exercise of being quantitative. I also, in the book, there's an appendix on this. I also rely heavily on what the smart money is doing, i.e. the insiders. Now, if you're just doing commodities, that gets to be difficult because there are no insiders who are buying gold or silver. So you then go to the secondary source, which is the mining companies, and look at what the insiders are doing there. By the same token, in stocks, you can look at what the oil companies, exploration and production companies, which tend to be very sensitive to the commodity price, what they're doing. And some companies' insiders are better than others in terms of telegraphing when share prices are attractive. But so, as an example, in oil, in January 2016, when everything had just totally fallen off the cliff for oil companies, insiders were buying aggressively, and that was a wonderful signal that we should be doing the same thing. Now, they were doing it when the oil price was down around $30. No, I guess it got below that, $25 a barrel. It was dirt cheap, but you wouldn't have known that unless you looked at what the insiders were doing. So they provide a little telegram for you that now's the time to be buying this. And I would do the same thing if I were buying gold. I would look to the to what the gold mining CEOs are doing, for instance, in terms of their shares. So you have to use these more quantitative tools that give you a window on the emotionality of the markets, so that you can navigate recognizing your own emotions and how they can lead you astray. Putting that aside and using these tools to help you decide when to be buying or when to be selling.
Okay. Well, Chris, I want to thank you for coming on Crush the Street, and it's been a pleasure having you on and really kind of picking your brain, because it really is true. Like, the psychology and the emotions of investing is, really what causes us to buy at the top and sell at the bottom in so many cases. And we're all vulnerable to it. Now,
Absolutely,
and you need those boundaries as an investor, and that's something that has saved me multiple times in the past. And to be honest with you, sometimes ignorance or disconnecting myself from the market has helped me, because I've enjoyed big gains, for instance, in cryptocurrency, by not watching the price go up and down so much. And that has been a great blessing for me. But had I paid too much attention to it, I should say, or cared too much about the price, I might have sold too early. But I also have a long-term belief on Bitcoin and cryptocurrencies that I think will transcend the price and what the technology is bringing to the world. And it's largely being recognized now. But Chris, I want to give you an opportunity here to share some final thoughts in general investing. Maybe tell us about your book a little bit, where people can find you and reach out to you. Again, thanks for coming on Crush the Street and sharing your insight with us.
Oh, Ken, thank you so much. So really, there's so much more available at chriswhiteauthor.com. And in there's a link to Amazon where you can get the book. But, at the end of the day, it's really about knowing yourself, knowing where your weak points are, where your strengths are, and understanding what your emotions can do to you in terms of signals for you to know when you're getting nervous and when you're not, when you're feeling emboldened, perhaps incorrectly so, and when not, and to counter those, talk yourself off the ledge, and then move on to make more rational decisions, and that's really where you will do best for yourself and for those you are investing for as you try to make wealth.
All right, Chris. Well, hey, thanks for coming on Crush the Street.